Joining us now is Bob Elliott from Unlimited. And Bob, you might not be alone in saying not so fast. I want to play this for you. Here's Boston Fed President Susan Collins on inflation.
3-month core is still at 3.4%, Steve. That's higher than we want. And so in order to get back down to 2% in a reasonable amount of time, we need to be patient and resolute. And I wouldn't take additional firming off the table. We need to look holistically at the data.
So is that bad news, you think, for people who are long now, or just reason not to get longer?
Well, I think if you look at what's driven the market rally on the stock side over the course, really since October 31st, it's been that move in bonds, right? Long end bonds are up about 8%, stocks are up about 8%. And there's a reason why that is because the Treasury effectively indicated easing through the QRA announcement, and then on top of it, we got a bit softer inflation prints than expected. You put those two things together, I think people are thinking there's a very quick shift to easing by the Fed, and now we're starting to see, look, cuts priced into March even, right? The initial cuts in 2024. And I think there's an appropriate amount of temperance being conveyed there, which is, you know, the road is long to bring inflation durably back down to 2%. Durably being that key point. And I think the Fed recognizes that a few prints aren't necessarily going to say, hey, mission accomplished, everything's over, particularly when the labor markets are still pretty tight and wage pressures are still elevated relative to where they were before COVID started.
I guess the counter to that is we've already got the brakes on with rates having risen so high as quickly as they have. And even if we don't get cuts in March, if inflation continues to come down to a surprising degree, like we've seen up to this point, maybe the market doesn't care if we don't get cuts in March.
Well, I think that's certainly a possibility. The challenge is if the Fed doesn't deliver the cuts, then you're going to start to see that move up in bond yields, right? Because the Fed needs to deliver the cuts in order to meet the market's expectations of between 4 and 5 cuts next year. No cuts, bond yields move up, and that's the exact thing that is detrimental to the stock market that's been so beneficial over the course of the last couple of weeks.
Well, that's what we saw bond yields fall so much this week, not because the Fed cut, but because inflation was lighter than expected. So in a way, doesn't lighter inflation reads, cooler reads, doesn't that substitute for a Fed cut sooner?
Well, I think the basic question is what's going to cause the Fed to cut? Will softer inflation cause them to move to ease monetary policy? Or are they looking at the overall picture of the economy and saying, hey, look, the economy's still pretty strong. Why waste your ammo today? Why juice asset returns today when instead, as long as the economy's doing okay, hold policy the way that it is and wait until you have to engage in that easing, wait until there is actually a downturn before you start to implement it. That's where the ordering is very important. First, conditions are going to deteriorate, and then the Fed is going to ease. And I think people are getting ahead of themselves, starting to position for the backside before the first couple of steps happen.
Yeah, I just wonder whether we have to actually get the cuts to experience in the equity market the effect of cuts, but I'll leave that alone. So got to talk gold, because you're a big gold fan, pointing out how much, if you had been holding it in your portfolio since 2020, it would have reduced volatility for you. But given where we are now, can we count on gold continuing to have that effect over the next 3 years?
Well, I think the main thing to remember about gold is non-interest-bearing money. And it's been impressive how much gold has held up in the context of long-term real interest rates rising 300 basis points. Now, they might rise a bit further. That might be a bit of a drag on gold from there. But eventually, you're going to have a situation where the Fed is going to have to deliver easier monetary policy. And holding gold in your portfolio may prove to be even better than holding treasuries because of that sensitivity and benefit when real rates start to fall on the backside. So from a strategic asset allocation, gold is really beneficial because it basically operates in a way that's very opposite to what stocks do.
What do you make of the impact of the drop in oil prices?
Well, it's hard to suggest that there's been a big macroeconomic driver causing the oil price market to move so swiftly downwards. And so what it's looking like is more a paper sell-off, where I think in some ways people are inferring from the bond market and the yield moves that are happening in the bond market that we're having a negative growth environment, and then that's translating somewhat mechanistically into the oil market in futures positioning and paper positioning. I think the challenge with that is that the reason why we're getting the move down in the bond yields is because people are expecting easier monetary policy, right, which should actually be beneficial to growth over time. And so I think people are looking at sort of a traditional intermarket action dynamic and not recognizing the actual fundamental cause of that bond yield move is actually supportive to oil rather than detrimental to it.
So you don't think oil goes down much further, it sounds like?
I think there's a real opportunity here in terms of from a skew perspective. Yeah. As we know, OPEC Plus is meeting shortly. They've already taken 1 million barrels a day off the market. If this oil sell-off gets any further, you have a combination of OPEC pulling more supply off the market, plus eventually we might have the SPR come back online and start filling it back up, both of which basically put a floor on where you are on oil prices. So I think from a skew perspective, still looks good. If you're going to buy a cheap growth asset in your portfolio, better to buy oil than to buy stocks at these levels.
All right.